Hey guys, it's Max Convexity here. Hope everyone's doing all right. Let's look at these options. This is going to be Option Basics Part 7. I'll probably quit saying which part number it is, but just Option Basics. We need to review the trade we made from yesterday. This morning, I don't know if you saw my episode this morning, but we actually sold part of our TSLY position. We're still up nicely in that TSLY position. We reduced our contracts from 5 till 3, and we took all the money that we had invested in the trade, all but $5 off the table. So this is free money now. We don't have any risk in the TSLY trade. These TSLY puts last until February. So if TSLY keeps having problems, and I don't think it's going to, I think today will probably be the low and it'll go back up, but I don't know. I'm just eternally optimistic. But if TSLY keeps having problems, we'll profit handsomely with no risk. And also in the scenario I was showing you, we were insuring 500 shares. We were trying to cover the downside of 500 shares. The problem with what we did this morning is since we sold 2 of the contracts, we have 3 contracts left, right? Well, we're only covering 300 shares. So anyway, there's always a trade-off when you do something. The good news is we don't have any more risk in the trade. The bad news is we removed our risk from the trade. The bad news is we aren't insuring our total portfolio anymore. Like I say, I'm kind of bullish. I bet it'll be I don't know, I'm just always bullish. Okay, but that's not what I got on here to talk about today. So we're going to adjust our position. We're going to manage our position with the QQQ trade. Just to review that trade. Yesterday I showed you that even though the market was making new highs yesterday morning, this was concerning me, how VIX was increasing. And this is VIX of VIX, the volatility of the volatility index. But when volatility goes up, it's a bad sign for the market, generally speaking. So that's what got us into this trade, and we almost picked the top yesterday. We bought a put up here, a 426 put for Friday at 87 cents. Well, lo and behold, the 426 put for Friday that is now $1.94, and we only spent 87 cents on it. So yeah, we're gonna take our profit. So let's do this. Let's take our profit, but then I'm going to show you what we're going to do next. So the managing options is the hardest part of it, but the market's offering us a profit right now. I still don't think the market may go down for another couple of days because that VIX index is still rising. You know, it looks to me like the market got overextended and may pull back for a couple of days. But anyway, what we're going to do, let's do this. We're going to do the same thing we did, or a similar thing. We're going to remove our risk from this trade. Now, we only have 1 contract, so we can't sell half our position or a portion of our position like we did in the TSLY trade. What we're going to have to do here is we're going to have to close this trade. And I just saw the ask or the bid at $1.89, so we'll say we got $1.89. All right, so that trade is closed. All right, so now we have all of our money back, plus we made $100. Okay, that's not bad. But wonder if the market's still not going down. Well, I mean, wonder if the market's not through going down. You know, that's kind of what I'm afraid. So let's do this. Let's take our original $87 or our $100 profit, however you want to look at it. We're going to make a free trade here, essentially. Also, here's what I like to do. The trade we did have was for Friday, was for tomorrow's expiration. It was this 426. Let's go out another day and let's spend about the same amount of money as we spent last time. Let's spend about 87 to $100, something like that. Maybe let's spend the profit we made in this trade. We just made $102 in this trade. We'll just spend the profit. There's a $101 option right there. It's going for 101. It's the 422. Okay, well, it's the 422, but we bought ourselves an extra day. It's the 422 for Monday. Since it's Monday, we're going to have to go down a few more strike prices to get the same cost. We could also look at a trade for tomorrow, and we could get the 424 if we wanted to spend our profit on a trade for tomorrow. But I say let's buy the extra day. This is basically free money, or we're just reinvesting the profit from this nice QQQ trade. And it didn't have anything to do with us being market timers or anything. It was just that the market was overextended, one, and that volatility index blowing up like this was concerning us. Anytime we see the market and volatility go up at the same time, we're probably going to look for puts. Anytime we see the market going up and volatility going down, that's how it normally happens. So we probably want to look for calls there or just stay out. Okay, so let's do this. Let's go to the option profit calculator, or let's go to my own. And let's see, QQQ. So days till expiration. I'm putting in the new trade here. So the new strike price is 420. What was it? 422 or 424? I forgot. We were looking at two of them. All right. So the one for Monday, the 29th, was actually, it was the 422. Okay, we're going to look at the 422. I just want to load it up in the option calculator so we can see what we're getting into. So strike price is 422. I was right. Let's see. And we don't know the price on expiration yet. All right, so we'll go down to the puts. We're just going to get one contract. It cost $101, 1.01. Strike price is 422. Okay, so our break even is 420.9. All right, so we're going to put an expiration price of 420 in there. Now let's look at the chart and see if 420 is realistic on the QQQs. 420 means it would pull back to here. There's Friday, and there's Monday. So 420 is we're looking for it to pull back to here, and right now we're here. That's not unrealistic. It's not like we want it to pull to down here or something. We need it to pull to 420, and at 420 we double our money again. And if it doesn't go there, that's no big deal because this money is profit. This is basically a free trade. We have all the money paid back from our initial trade, and we're just spending the profit and trying to roll it in here. But if we can get a multiple day pullback, and I can show you back on the chart, the last time that this index started going up was right here. It was right here on this day, and then right here. Well, okay, it went up on that day, and we only got a one-day pullback, okay? But then it went up, then it did the same thing later. Right here, it started doing the same thing. It started going up, and we got a two-day pullback. So anyway, pullbacks are kind of hard to come by. I found one last night. There was one last night right here, right through here. We did get a multiple-day pullback. We got a 1, 2, 3-day pullback. Pullbacks are hard to come by when you're in a bull market. So anyway, we're playing for a 2 or 3 day pullback, and we're playing for a price of 420 by Monday. So it's not totally unrealistic. I don't think it's too stupid to do. Also, all these things kind of assume that you have a 401k and that you're long through your job. Everyone wants the market to go up. Just having a house and having a job and living in the American economy, you're generally bullish on things, and you generally do well. If the market goes up, your 401k should do fine. That's why I like these trades, these put trades, to try to catch pullbacks in the market and just put some extra money in your pocket. If this trade doesn't work out and we lose our $100, one, it's not a big deal because it's just the profit from the other trade. And two, our 401k will probably make well more than $100. If the market continues to blow up for another month, our 401k will be up, several $1,000s. So that's kind of the perspective I'm trying to show you guys also. And don't do these trades with real money. And I'm making them super small on purpose in case somebody is trying to do them with real money. But if you're trying to learn options, start off with 1 lots and 2 lots. In other words, 1 contract and 2 contracts, because they are super risky. And when you buy an option, it's a decaying asset. All right, so let's go back to the calculator. So, all right, so 422, yeah. So if we can get down to 420, it'll be an 81% profit. It costs $1. It costs us $1, and we'll get out of it for $2. If we can get, but heck, it wouldn't be unrealistic that it might drop to 415 or something. And if it does that, we'll have a nice profit. But the other thing is, I wonder if it doesn't. I wonder if it goes up to 430. Well, we're going to lose $1. Why does it say $1? I meant to put $1.01. Okay, we're going to lose $100, okay? But the guy that shorted the stock instead will lose $126. And that's not right either. That assumes he's all right. Well, the stock price. What's the stock price today? What is the QQQ trading at right now? 425.68. Okay, so we have to put the right number in the calculator so I can do the 425.68. 425.68. All right. So anyway, if it does go to 430 or something, we're out $100 and that sucks. But the guy that shorted the stock is out $400. All right. These usually work out better, in my opinion, especially on shorts. Buying a put is a superior way to short versus going out and selling the shares short. Just my opinion. But to give you guys the other side of it too, let's look at the other side of it. Let's say it goes to 420. We make $100, $99. This guy makes 568. The difference is because when you short stock, you don't have to pay any extrinsic premium. This dollar we're paying is all extrinsic premium, which means it's guaranteed to be zero. The extrinsic portion of it is guaranteed to be zero by the time of expiration. So we need this option to go in the money to have any value. Our strike price is 422. That's why if it goes to 420, even though we'll have no extrinsic left, we'll have 2 points of intrinsic. So the option will be worth 2. We'll double our money. But that's on small moves. Yes, it'd be better just to short the shares for sure. It's just more risky also because when you short the shares, you have unlimited loss to the upside. Wonder if the market goes up, and it could do this easily. Wonder if it goes to 440 or something, and the guy shorted the shares, he'd be down 1,400. We're only out $100. All right, so we're going to load it into the option profit calculator. Let's see, we're going to build a long put. We're using the QQQ. And Monday's expiration is the 29th, and we're going to roll down to the 422. They're showing an ask of $1.03, so it was $1.01 when we started. I've been explaining it to you guys. If I was doing it myself and didn't have to explain it, we would have got it at $1.01. All right, so I'm just going to load $1.01 in there. Oh yeah, okay, and we're just going to do one. We're just going to do one contract. Be nice to do 2 contracts so we could maybe sell half of the position if we can get it to move in our favor, but I don't want to spend that much money right now. We could go out of the money further, just to show you the alternatives. If we could go out of the money and find a 50-cent option, which would be the 419, but okay, and we could have 2 419s, or we could have one 422. In this case, I think it's better to have one 422, because 419 is asking it to move a long way. In my opinion, I don't know. So we're just going to stick with the 422. Like I say, if this course gets popular, and I'm hoping you guys like it, and it does, I might start doing this on a live stream, and I'll take input from you guys. Let me know if you'd like that, or I might start doing Twitter polls, and we'll do some more interesting stuff. I'm just trying to show the basics of buying and selling options. And this is assuming this is for people that really haven't done it before. This is way too simple for somebody that's been doing it a lot and, buys and sells covered calls and credit spreads and all that kind of stuff. So I apologize if you're one of those more advanced people, but I'm trying to get everyone up to speed. Anyway, give me your feedback. Let me know what you think. We'll see how this does tomorrow. Oh, and the game plan. We always talk about an exit plan when we get in an option. Okay, so our exit plan is, here's our plan. You don't want to just buy it without our plan. Our plan is that tomorrow or Monday, if we get a chance, if the price doubles at any point, we'll probably sell it and maybe roll out another day and roll down and out. In other words, take it off the table. If we can get it go from 100 to 200, we'll take the $100 profit. And then maybe, since that means it's going down, maybe we'll try for like a 410 strike for Wednesday or something. We'll see what's available. We may try to keep it going and see if we can catch a multi-day downturn here. So we'll see. All right, guys, thank you for tuning in. You guys have a wonderful day. Thank you very much.